This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with Manus Clancy and Diane Crocker. Welcome to this week's episode. We're diving into the private REIT market with insights from Partner Valuation Advisors, who recently released Q3 data. Our guests are Brandon Nunnink and Eric Enloe, both senior managing directors at Partner Valuation Advisors, a national commercial real estate valuation advisory firm, and it's one of the top 10 nationwide appraisal firms as reported by our Lightbox platform. Partner in 2023 has more than 100 valuation professionals nationally and has executed more than 4,400 valuations with an aggregate value of $113 billion. So we're looking forward to hear what both of you have to say. Let's start by exploring what distinguishes the private REIT market from public markets. I know you have done some analysis on this. And Eric, why don't you get it started?
Thank you very much. Appreciate it. Glad to be here. So what's interesting about the public and the private REIT, or the public markets and the private real estate markets, is they operate differently. So the public REIT markets, where you can trade in and out every day, and what ends up happening is there's a lot more kind of real-time movements associated with that. So in many ways, the public markets are looked at as the bid, right? That's where investors go in and where they think assets are worth, and in this case, what REITs are worth, but that gets down fundamentally to assets. And that's where the bid comes from. And where you have private markets, which in many ways is much less volatile, and it's more streamlined to where you don't see as many changes, and that ends up forming the ask. Really, that's what we've seen in the last few years, where everyone reads that there's a lot fewer transactions that have occurred. It's because that bid-ask spread is wide. Buyers and sellers have not been willing to meet in the middle and transactions to come together. And that's really what we've seen, whereas now we're starting to see a change, and we're starting to see more transactions. It's clear from the 50 basis point cut that created a level of optimism amongst the buyer pool that asset values would be, potentially going up in the future, and created, like I said, that sense of optimism. And as a result, we are starting to see more trades. And what's also happened is on the private markets, those parties have gotten a little more realistic on where values are at there, and you're starting to see that kind of meeting in the middle.
That was a great opening, Eric. I've been really looking forward to this conversation. I know you guys have your tentacles everywhere. You see a lot of different markets by geography and property type and so forth. So I want to go a little bit off script very early and just ask you something maybe a little bit far ranging, but fairly recent. Twice in the last 4 years, we've gotten to a point in the market where there's no visibility. Right? In the early days of COVID, no visibility. And then you might say in 2023, when there weren't that many office sales taking place, a real lack of transparency. How does your team handle moments like that? How do you handle times where, it's very hard for people in the market to really establish value?
Yeah, man, that's a great question. I remember in 2020, right, at the onset of COVID, when you couldn't go out to eat, right? The offices were empty, and it felt really strange to just about everybody in this country. When it comes to valuing real estate assets, that continued. There's a large, you look at the 26 Odyssey funds, they have to mark their assets quarterly. And that didn't stop during COVID. So, I would say what we did is we threw the whole kitchen sink at it. That's what happened. So because there weren't as many trades that occurred, you're talking to brokers. And I think one thing that has gotten lost a little bit on the community, there's been on just kind of the valuation industry and the real estate industry in general, there's been properties that have been listed for sale. There's been a lot of properties that have been listed for sale in the last few years. They just haven't all closed. But there's been offers on those properties, right, that the seller just didn't like that offer. Right? They said, I'm not willing to transact at this price. But the market spoke. I mean, there could have been 2, 5, 10, 20 offers, expressions of interest on where they'd be willing to pay. So the truth is there in the middle, right? The seller wasn't willing to take it. The buyer's offer got rejected. the truth is there and something in the middle. So I think there's a lot of thoughtful analysis to be done around projects that were listed that didn't close. I think really getting connected with the brokerage community, and, valuations can't be done in a vacuum sitting in front of a computer. You got to be out there, talking to brokers, talking to buyers, talking to sellers, talking to all the parties involved, and what they're seeing and what they would offer on this building and why. And when you understand the why, then it all kind of hooks together. So even though there weren't trades, we're looking at listings, we're talking to brokers, we're talking to other valuers in the market too, buyers, sellers, leasing agents, institutional owners, and that's domestic and, global capital. It's, really depends on the buyer pool for the asset, but it runs the gamut. We're looking at third-party research too. Like Green Street does a really good job with their research. I think there's something to be gleaned from that, right? Looking at some of the results from the NCREIF index, and we value some of those Odyssey funds that contribute. Those results are part of the NCREIF index. Looking at what those results are at, talking to asset managers. So it is a whole kitchen sink approach where you are trying to talk to everybody you can. You're trying to get any kind of data points that you can out there, and really trying to, put that all together into a valuation that's really thoughtful and means something.
That's interesting, Eric. I'm gonna jump in here for a minute because you brought back a funny memory for me from during the COVID days, where I remember talking to an appraiser back then, and the term he used that I'll never forget was, look, we're trying to basically guess at valuations without any comps to work from. And he used that Disney term, Imagineering, that he felt like he was Imagineering a property value because he was using whatever he could get his hands on at the time. So what I'm hearing from you sounds encouraging, which is, up until now during this valuation divergence, there's been this big gap between public and private real estate cap rates, and it's been really stubbornly slow to close, I guess is the right way to say it. But what I'm hearing from you is that you expect those to get more in sync as the transaction market kind of regains its footing and as that bid-ask spread starts to narrow.
That's correct, Diane. And we're already seeing it. So we're already seeing that narrow. You're seeing that actually on the private side, prices are starting to go up. On the public side, you're seeing that just that kind of narrow a little bit. And those are kind of, they're very volatile, but you're closer to equilibrium between the private and the public. And that's a sweet spot where you're going to see purchases. And on the private side, you're seeing values in REITs where the privates are starting to take public REITs private. So they think that there's opportunities with these REITs. Blackstone has been a big player in it recently on several transactions. So you're starting to see that narrow. That's what makes a healthy market. What's interesting is the markets have really varied. I mean, I think it's fairly widely acknowledged that the San Francisco office market has been one of the most challenging in the country. What you've seen there is the kind of reset of that market. It has been going on for about 12 to 18 months, but it's pretty far along in the process now. And there's pretty good pricing clarity where on a stabilized basis, that was 1,000, 1,200 a square foot market for office buildings, for really great buildings. Now you're seeing a kind of clearing price. There's a ton of transactions that have occurred in the $250 to $400 a foot range in San Francisco. So that doesn't mean that 1,200 a square foot premier office building is now worth 200 or 300, because most of those trades have not been the best buildings in San Francisco. But it serves as kind of a floor for where there's a clearing, and those people buying assets in that market at 300, 400 a foot, they're now trying to get to, in 5 years, 6 years, hopefully they get to 700 or 800 a foot. Still less than the 1,200 a foot, 1,000 a foot. That's kind of the thesis to where there's been a market clearing in that market. And so that makes it actually a healthier market than most that are still kind of figuring out what clearing price is, and then they're going to go through this process. Hopefully that's helpful.
You guys talk to so many people. It seems like you would be natural leading indicators of where the market is, that before you're seeing enthusiasm, people are talking a little bit more enthusiastically. Maybe before we got to the summer of 2024, where enthusiasm was starting to pick up just a little bit, maybe you saw it. Is that a fair statement to where you are? And if so, where's the enthusiasm gauge now for the CRE market as we get to the end of 2024?
I think that's a fair assessment, Manus. I think we have seen more enthusiasm re-enter the market. I think we saw it over the summer, as you stated, in terms of people, the expectations that interest rates would start to come down. And with interest rates coming down, there was some expectation that cap rates would come down. And as Eric stated, we were starting to see a little bit of stabilization in terms of the tenant demand on the office side. So I think all of that starts to build momentum towards positivity in the transaction markets. I think everyone was a little surprised by how long it took for interest rates to start to come down, and I think everyone's been maybe a little bit surprised at kind of the inverse movement of the U.S. Treasury relative to the SOFR rate coming down. So that cold water on some of the positive momentum that I think we started to see and feel in the summer and into the early fall. But I still think, generally we're seeing and feeling a lot more positivity from a momentum perspective as we head into late fall, into the winter months here than we were seeing certainly in Q1 and early Q2 of 2024.
I think we have our headline for this podcast. Momentum is on our side. Brandon has called it. So I like that. I like that posture.
Let's talk a little bit more detail. You did some cap rate analysis in this review that you're going to be publishing, and you highlighted cap rates for private REITs. For example, we're seeing some exit cap rates that range from 5.5% to 6.7%. Can you break down these figures a little bit more specifically for the audience?
Sure. Yeah. No, we, as Eric said, like to look at kind of the bid-ask spread between the public and the private markets. And a great way to do that is to look at the open-ended funds placement memorandums on the private side and compare that to the implied cap rates and discount rates on the public side. So that's what we do on a quarterly basis. We go through and look at all the big funds on the private side and extract their exit cap rates and discount rates from their disclosures. And then same thing, we compare that against the implied cap rates and discount rates from Green Street. What we had seen is those gapped out pretty wide in kind of 2023, where there wasn't a lot of agreement in terms of what the public markets implied cap rates and discount rates were relative to the private markets. And as Eric mentioned, that's now come back where they're a lot tighter. There were also some interesting anomalies within the private markets as to how different funds were valuing themselves. And the market reacted somewhat negatively to that. You saw some of the funds facing fairly large redemptions, which is somewhat of an implied situation where the investors are saying, hey, if you really think your assets are worth that, we'd like to trade out at that price because we don't agree with you. And so you saw some redemption queues at a couple of the larger private REITs. And since that time, they've changed their valuations a little bit. I think the market's recovered a little bit. And so those redemption queues have gone away. But now I think we're starting to see a lot more, a tighter consensus amongst the private REITs in terms of how they're valued. For instance, on the industrial side, the most aggressive private REIT is Hines Global. Their exit cap rate out there right now is 5.57, and the widest is only 6%. And there's quite a bit of consensus in the 5.7, 5.8, 5.85 range. The private REITs are very closely on top of one another with respect to how their exit cap rate views are with respect to industrial. Similarly, you see that pretty tight convergence on the multifamily side. So, the most aggressive again being Hines at 541, the most conservative being Brookfield at 580. So a pretty tight gap there, 40 basis points, 39 basis points between the most aggressive and the least aggressive cap rate. And there could be explanations of that at the asset level. We don't dive in at the asset level. Hines might be sitting in some markets that are expected to have greater rent growth. They might also just have better located assets. There could be very good explanations for that 39 basis point gap. But what we generally see is that the market is very well aligned on the multifamily and the industrial side in terms of where they're seeing exit cap rates. I think what's interesting is you start to see a pretty big divergence in terms of how the private REITs are valuing their office assets. And that is a little bit similar to how we see the broader market. The market is struggling the most on the price discovery side from an office perspective. And it's really market by market and even sub-market by sub-market where there's been good price discovery or there hasn't, and people don't really know where to trade right now. So on the office sector side, we're seeing exit cap rates as low as 530 for Blackstone and as high as 730 and 750 for Invesco and Brookfield, respectively. Pretty big divergence there of almost 200 basis points on what the exit cap rate expectation is between Blackstone and Brookfield. That's a wide divergence in terms of asset valuation. Some of that divergence is then reflected in the discount rates, where Blackstone is a little bit more conservative in terms of the premium discount rate over their cap rate of 180 basis points. They're the most conservative in that realm, but still their discount rate is significantly lower than the discount rate implied on the rest of the office REITs. Ares coming in at 860, Invesco coming in at 880, significantly more conservative discount rates in terms of looking at what kind of that risk-adjusted return on future office cash flows looks like relative to some of their peers in the marketplace. Again, there can be explanations for that. There's a lot of credit tenancy sitting in the Blackstone portfolio. There's some healthcare tenancy sitting in there as well. So that there are certainly explanations for why Blackstone deviates from the rest of the market, but that deviation is pretty wide. And I think the marketplace spoke a little bit last year when they saw that deviation, and that led to some of the redemption queue that you saw with Blackstone.
So with the wide swath of transactions that you see across the market, certainly gives you a bird's eye view into what's happening across the U.S. How about you give us a sense of where you're seeing opportunities in the market, where people may be seeing undervalued properties that may warrant a sniff from people that are looking to put money to work?
I think there's a couple different areas where I see opportunities. Even though we've had this 50 basis point cut, even though there's positive momentum that rates will continue to go down, cost of capital is still much higher than it was several years ago. And everyone has kind of a recent memory bias, right? When you look at historical averages, rates aren't that high. But when you look at, the last few years when essentially money was free in 21 and 22, it feels high. So I think opportunities exist in what I would call lower capital type of investments. So manufactured housing is a great example. Manufactured housing, you were renting pads underneath mobile homes. And generally the owner of the manufactured housing unit or mobile home, they own their own unit. So you're collecting pad rent. That feels very defensive when you're essentially renting land. Secondly, unlike apartments, whereas a garden apartment might be 200 units over 15 buildings, that means you have 15 roofs, right? You have all the unit appliances on the interior. But in this case, in mobile home parks, you're renting land, and generally the main building improvements that you have associated with manufactured housing is the clubhouse. So you got to maintain that roof, right? And make sure that's nice. Maybe there's a playground, but from a capital perspective, the amount of ongoing investment is considerably less than kind of other multifamily products. I think another one kind of following a little bit of the same theme is self-storage. Self-storage has been a little bit challenged from a supply perspective, and there's been pressure on the achievable rental rates over the long term. Certainly believe in storage. Think that's an opportunity. The capital investment to construct storage is one of the lower kind of per foot costs out there relative to office, relative to multifamily and others. So I think that's a pretty good opportunity. I think the next one is a little bit of a contrarian look to some degree, but it's office. And it is not just all office. It's what I would call kind of selective office. We saw a trade recently that was a few miles from a major airport in a suburban market, traded around a 10 cap, 90% leased, good credit. That feels really good to be around a 10 cap on an entry price on what is really good office product. So I think there's opportunities in suburban office. It's selective submarkets. It's not all submarkets. I do think there's opportunity in CBDs. The CBDs are the ones that have been somewhat more battered than the suburban markets. And whether that be fear of crime, people not coming to the office, not wanting to come downtown. The reality is, and we hire a lot of young people out of college, and just talking, the 22 to 26-year-olds haven't given up on being in cities. And they want to be around other young people. That's all there is to it. They do not want to hang out in the suburbs and go to the movies. That's not a great night to a 22 to 26-year-old. They want to go to bars, restaurants, sporting events, if they're into music, theater, but most importantly, they want to hang out together, and they would do those things in a group. And so cities, I think, are poised for a comeback. I was in New York 3 weeks ago, happened to pick one of the weeks when the UN summit was in, so it was extra crazy. But there's a lot of activity in New York. What's interesting, the CBD of Chicago is a little bit certainly quiet on Mondays and Fridays. The activity, even Tuesday to Thursday, isn't what it was in 2018-19, but it's picking up. But if you go to the places that people want to go out in a market like Chicago, Lincoln Park, River North, Fulton Market, those bars and restaurants have never been busier. And I see it across markets, Boston, the same thing. People want to get together. So I think there's opportunities in selective office investments that have good window lines, right, that are well amenitized. And so I do think there's real opportunities. I'll bring one other thing up. HSBC in New York, their former office, they were, I think, averaging around 40% attendance. They moved to Hudson Yards, and now they're closer to 80% attendance. So, and I've seen that play out time and time again. You're seeing companies, I wouldn't say ask to have their team members back, more of a demand to have their team members back in the office. And there's a big difference. And so I think there's an opportunity in selective office buildings for, you'll look back in 5 or 6 years on the basis that they got in to kind of view that as, an incredible, investment.
That HSBC story is an interesting one too, for the parenthetical, which just this past week, Amazon was rumored to be taking that Fifth Avenue space. We thought that was kind of dead space walking, and now Amazon's circling 350,000 square feet there, which would be a huge vote of confidence for that Midtown Manhattan, New York office market, should that come true. So we're all keeping our fingers crossed there. Let me come up with a follow-up on that office space story. It's kind of a tangential one, but you go back to the 90s, the price discovery period, the depth of the crisis really long and played out. After the great financial crisis, you could say the same thing. Didn't see a lot of transactions. When we saw the catastrophe in B and C class malls in 2017, 18, 19, that took a really long time for these things to clear. Yet in office, we seem to have gone from panic to low valuation to sale in many of these markets very, very quickly. Did that surprise you at all?
It did. And what has also surprised me is the markets aren't operating all at the same rate. So I mentioned San Francisco. That's a market that was and is one of the most challenging, but that clearing of the market happened fairly quickly, to your point. But in other markets, you're not seeing that kind of velocity of, these buildings selling at these new prices or being given back to the lender or just being flushed out. So there's a brand new basis for somebody, so they feel like they can invest in their building. I don't think there's any office owner out there that thinks that they can just keep their office building as it is, unless it's something truly built in the last 3 or 4 years. But anything that's built, say 5 years or older, they've got to invest in their buildings. And so this lower basis is allowing them to invest in their buildings. So it's been interesting, but it's truly been a mixed market. We look at kind of the Miami market as being one of the strongest, right? Clearly, they've had strong in-migration to Florida overall, but the Miami office market's, pretty darn strong. And there's true demand there, which is a little bit unique from some other markets where it's really a demand issue to some degree. That, yes, you read the headlines about the tenant that had 100,000 feet and they want to renew. That's great news. They want to renew, except they don't want 100,000 feet. They want 60,000 feet, right? There's stories out there like that, but there's stories going the other way too. And there's story where tenants have said, yeah, I want to renew and I want 20% more space, or I want 30% more space. There's a lot of headlines, but this somewhat of a clearing of the market is it's ongoing. It's happening. I think we have another year or two till, we can really say, okay, here's a brand new basis. But that's that year or two, that's overall for the market. There's some that will be much quicker. But what I think does get lost, and it's certainly on the headlines, is office is bad. Office is terrible. That's not really the case. There's certain markets and products that are challenging. But go to Cherry Creek in Denver, that small submarket, 90% plus leased, and a lot of demand to be there. I just mentioned Miami, a lot of demand to be there. There's certain pockets around the country. Fulton Market in Chicago, although a little bit of recent softening, one of the hottest, places to be in the country for office. So I think you even look at New York City, the buildings near Grand Central, that is a real beacon of activity. I mean, One Vanderbilt, which is in certainly the top couple office buildings in the country, if not the best office building in the country, right by there. But all of that product, and some of that is product that's 15 years old. It's not all brand new. It's performing pretty well when you're around Grand Central. So I think there's a lot of layers to kind of peel off the orange when it comes to office, because there are some really strong areas, even Las Vegas. There are some submarkets there that, the Summerlin area does pretty well. That's where the activity is in Las Vegas. Go to LA, the Century City. Downtown is challenged right now in LA, but Century City isn't. People want to be there. There's some mixed use to it. There's a lot to it, but I think there's a lot of opportunities.
Yeah, Manis, I think the data is starting to tell that story, right? I think we index transaction volume activity across the country. And on the office side, Class A is only averaging about 21% of the average transaction volume that occurred 2014, 2019. So we kind of look at the pre-COVID period. Quarterly, transaction volume on the Class A side is 21% of what it was. On the Class C side, where, you're starting to see some redevelopment plays, it's 70%. And as Eric mentioned, in the hot markets like Miami, it's over 100%. Washington, D.C., it's over 100%. Atlanta, it's over 100% on the Class C side. So some markets where you're seeing continued in-migration, you're seeing continued job growth, that Class C redevelopment is definitely occurring. But even overall, Class C is a much hotter market than the Class A market, because you're seeing people start to step in and look at those redevelopment opportunities, which is exciting. And I think it's happening faster in office than as you mentioned it did in some of those dead malls, half a decade ago. There's still a lot of room to run. There's still a lot of distress on the office side to get cleaned up. Not everything is going to be an office building, and there's not demand for a lot of that Class B, Class C stuff that's just not as well located to rooftops or those amenities in the evenings that Eric mentioned, the bars, restaurants, sporting events that people want to get to. But I think what you're seeing in Atlanta around the Battery, and you're seeing in certain markets, is when there's entertainment venues, it drives office demand because people want to be there. They want to stay after work and go do some of that live work stuff that was hot, pre-COVID. Got really cold there for a couple of years when we had to social distance, but it's starting to come back. And I think, we're believers in the momentum of cities, and that the young professionals of America want to matriculate to cities and work there and drive demand on both the multifamily and the office side. And I think that's, we're going to continue to see the recovery in those markets as a result.
For our audience that focuses on forward-looking indicators, and we spend a lot of time on this podcast looking at some of the tea leaves to see what's happening, what are some of the signals that you're watching that might indicate shifts in valuation or demand in the near term?
Yeah, I think continuing to watch the office utilization rates is going to be important, right? How are people getting back to work? And then I think, really coming out of the election, trying to figure out what's going to happen in the regulatory environment comes into play across a few different avenues there. One, affordable housing restrictions, when people are developing new housing, what percentage of affordable units are they required or required to pay into a fund to support? Transfer taxes has come into play, with new transfer taxes in a lot of major cities, and then again, with respect to building performance standards, they haven't hit too hard yet in the United States. As Eric mentioned earlier, they're coming a lot more into play in Europe right now, but I think that there is a movement towards building performance standards in the United States, and some of the economic impacts of those with respect to fines for not maintaining building performance standards with respect to your carbon footprint, et cetera, are going to come into play more than they have, with New York City kind of leading the way as the most material and largest market that has in place regulations that'll start hitting in the next 5 years. So, those are some of the signals that we'll continue to watch as to what the regulatory environment does to valuations in terms of restricting rents, requiring some supply restrictions in terms of those affordability requirements, and then what's going to be required in terms of capital expenditures required to keep your buildings in compliance with building performance standards on a go-forward basis.
Brandon, I'm going to jump in and switch gears here a little bit away from market metrics and talk to you about technology, because I last talked to you about this when you were on the PRISM advisory board earlier this year. And we chatted about the fact, as I recall, that appraisals obviously are one area of commercial real estate that's very data driven and full of, call it, disparate data sets that aren't necessarily easy to patch together and access. So 2 questions here for you to field. One is, where are you seeing progress on that front of patching databases together? What doors does data standardization open up? And then second, what about AI? We're all hearing so much about artificial intelligence. So I'm curious about where you see that fitting into the appraisal world and what challenges you see it addressing.
Dan, I'm going to attack the second part of the question first and then circle back around to the data alignment. On the artificial intelligence side, I think we're seeing pretty disparate approaches, which isn't surprising on a leading edge technology like artificial intelligence. But we're seeing and hearing from some major banks that we're not allowed to use it at all, and they're not using it. I think there's pretty strong alignment around nobody should be using private customer data outside of a walled garden. So not using the public domain large language models, but at least bringing those into a commercial walled garden that protects client and customer data is kind of a bare minimum if somebody wants to use artificial intelligence in our space. But again, some banks are saying can't use it at all. We don't want you to use it at all. We don't think it's understood yet and shouldn't be used. On the flip side, we see other major banks putting every single appraisal through a large language model and asking it certain prompts to basically provide an automated review and say, hey, were these requirements of the bank met? Or are you seeing any disparities in the analysis? And we've seen some pretty cool demonstrations of putting things through these review models and spitting back out what the highlights and some areas of improvement should be from an appraisal. And I think that's only going to get better and better, which we're kind of excited about. I think the industry being led towards higher quality is something that I think that Partner Valuation Advisors is very excited about. So I think that, from the AI side, we're seeing that. We're also seeing and hearing that banks are now putting leases through an abstract model and then comparing that against what the lease terms are in the appraisal. So before, the banks might say, hey, any tenant that exceeds 10% of the rental revenue of an asset needs to have their lease abstracted and compared against the rent roll provided by the borrower. The banks are doing that themselves now, and they're comparing that against the terms that we're modeling out in our appraisals. And appraisers are going to have to get up to speed on similar models. That's interesting. There's a giant race out there to try to extract data from especially rent rolls and P&L statements. There's a lot of firms out there doing interesting things on that front and trying to make the appraisal process faster and easier, which I think is great. We believe that our people's time is best spent analyzing real estate, knowing market trends, trying to stay connected with the brokers, like we mentioned earlier, and not spreading financials or copying rent rolls over. So to the extent that we can leverage artificial intelligence and data extraction tools to take some of that non-value add, but definitely required components of the appraisal process out of the human realm and put it into a technological realm, that certainly helps us be faster and cheaper in terms of the services we can provide while still providing the same or higher quality.
So you hinted at this a little bit, Brandon. Let me give you guys a wide open field to go after those one. Eric or Brandon, you could either one answer this question, but what makes Partner Valuation Advisors special, right? You talked about your people a little bit and your breadth of market. Give me the thing that keeps you coming to work every day, feeling good about what you're doing. And what do you and your team do best?
I think one of the things that we really like about the firm that we founded is there aren't geographic boundaries. I think some of our competition faces a little bit of a challenge in terms of different quality of product being produced by different offices because of different geographic fiefdoms. And we don't have that at Partner Valuation Advisors. We built the firm on the foundation that we want all of our people to be regional or national experts in a property sector. Part of that is getting to know the market that you actually sit in, but it's also getting to know the region and really understand property sectors at the regional or national level more than just being maybe a generalist in a certain market, especially maybe a secondary or tertiary market where there's just not enough transaction activity to really become an expert in a space. The other thing I think we really focus on is we really try to inform our appraisers in terms of what's going on and staying connected in the market. So as Eric mentioned earlier, we really strive to reach out to the brokers in the market and understand what's going on from a leading perspective, and then feed that data into our models and into our appraisers process so that we're not just looking backwards as to what previous transactions have said, but trying to look forward and understand in the current marketplace where things are likely to transact as opposed to where they would have transacted 3 to 6 months ago.
I think we're in the midst of just a valuation revolution right now is what's going on. And I got into the business in the late 90s. Appraisals got delivered in 6-7 weeks. That was a standard delivery time. That then moved up to 4 weeks, 3 weeks, then 2 weeks became the expectation. And now it's generally 2 weeks, 3 weeks for deliveries. That will be going to 10 days, to 7 days, to 4 days. And we're in there's finally change in the valuation industry to where an appraisal done in the late 90s when I got in the business doesn't look that different today than it did then. And we're trying to turn that absolutely on its head and come up with deliverables that we don't want someone to look at a report because they have to look at it. We want someone to look at it because they want to look at it. And it's using technology, coming up with the greatest data that's out there, presenting it in a manner that is captivating to the eye to where it really means something. And, appraisals should look more like offering memorandums with fantastic color and graphics and tons of accuracy being the most important thing, right? But there is a way to present really, really smart, intelligent, correct data, but in a manner that's different than anyone's ever seen. And that's a lot of what we're trying to do. And I see productivity per professional, in terms of their billings, their efficiency, their productivity, all of those things going through the roof in the next 2 to 4 years to where it's dramatically different than it even is now. But the great thing about it is it's productivity because you're just putting in a few more hours every day, right? 2, 3, 4 more hours. That's not the goal. We want our people to have a great work-life balance, but be super efficient. And that's where we're getting to where people's billings, productivity, whatever you want to call it, will increase. But we call it easy productivity. It's because the tools are better. And that's kind of I think a lot of the gold standard that Brandon and I and our team at Partner Valuation Advisors we're working towards.
So Diane, kind of circling back to the first part of your question about what we're seeing in terms of how technology is changing. I think the other major area outside of artificial intelligence we're seeing is improvements in benchmarking. You guys are helping lead the way there from a Lightbox perspective. You guys are rolling out a schema where every valuation is now going to have the data extracted and provided to your lender clients to allow benchmarking of things like cap rates, value per unit, or value per square foot. And I think that's really important to ensure credibility in the industry and to try to help, again, lead the appraiser to tell the story why if something's trading tighter or wider than the general benchmark is saying, tell that story in the appraisal, and it drives credibility in the industry. So we're excited for that evolution. I think it's been a long time coming. It's been a dream, I think, of the industry, and I think Lightbox is helping lead the way there. And I think there's some others out there also leading the way on benchmarking, from MSCI PRIA, from the Altus intelligence tool, Fannie Mae starting to require some structured data, all moving towards better benchmarking in the industry. And I think that's what we're going to see in the future.
If anyone has questions about PVA or the analysis that you guys covered today, how can they reach you?
And you can reach Brandon or myself. Brandon's email is bnunnink, BNUNNINK @partnerval.com, or myself, Eric Enloe, EENLOE @partnerval.com.
Thank you, Brandon and Eric, for joining us today. Great conversation. Thanks to our producer, Josh Bruning. Join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.